What's up, guys? Tyler Wayrung here, doing my first live stream. So let me know if you guys can hear me all right. Um, Maybe some technical difficulties as we work through this, but thought we should hop on. I know it's been a while since I've been able to crank out a video. I've been remodeling my kitchen, and it's kind of thrown my life kind of sideways lately, but we're getting lots of DMs, lots of questions from you guys about the current housing market. And so I wanted to just hop on here and try this new live feature. Let me know if you guys like this or not in the comments to see if we want to try to do these more often. So let's jump right in. First off, happy Friday. Appreciate you guys hopping on with me. And yeah, let me know what you guys think about this. I'm using StreamYard, trying to figure this software out as we go. But I want to talk to you guys about the housing market, and then we'll jump into some Q&A. If you guys have questions, go ahead and drop them in the live comments. We can hop into your scenario. I think I'll be able to get more into the specifics on these live streams and be able to ask questions back. I do try to answer all questions typically, but sometimes it's difficult not knowing the full scenario. So let me share my screen here if I can figure that out. Boom. All right, so I want to talk first about interest rates and what's going on with this market. So as you guys can see here, out on NerdWallet, current interest rates have almost doubled. All right, we're going from like the low twos just about a year ago. So looking at July of last year, 30-year fixed interest rate loans at 2.8. All right, so just under 3. And as you can see lately, we've spiked here, almost doubled. So I predicted in one of my earlier videos that we would bump a percent, maybe 2, but we're pushing it. They're even going farther and faster than I thought in my projection. So let me do this here, get this out of the way. Oh, sorry, I guess it wasn't sharing before. But yeah, so what I was showing here, low twos on this blue line, showing the 30-year fixed interest rate. And yeah, now up, it looks like we hit 5.5 at one point here in the peak, and then slowly starting to back off. So I get lots of questions like, hey, is this going to crash housing? Is this going to be the next 2008? And in the short, my answer is no. So there is still such a crazy supply shock, but this is a bigger impact than we expected. So wanted to pull this up here and show, on a $250,000 loan, we're going from, let's say, a 5.5%, which is the current rate or close to it. So that's a $1,400 monthly payment on a 30-year fixed from just over, a year ago. Let's just say we're at 3%. So you're looking at almost a $400 increase in monthly mortgage payment. And so most Americans go out there and see what they can afford every month, and that kind of gets them into the house that they can buy. So going strictly off affordability, that's almost a 40% increase in mortgage payment that these folks are going to have to be paying. So it certainly will limit the buyers or lower the price expectations that buyers can go out into the market with. However, the reason why I don't think it's going to crash housing, I do believe it will slow down the rate at which we will climb, is first, inflation is still at an all-time high. So your money's being worth less every day. And the more important or the biggest factor in that is also going to be that the supply is just so low and there are still so many people out there. So if there were 10 people out there competing for a house before, this might lower that or knock out the bottom 6, and you may still have, 4 to 5 offers. Again, my public math isn't great, but yeah, so you're still going to be in multiple offer scenarios, especially on houses that are nice and fixed up and look good. So yeah, I don't see this really crashing, but truly just slowing things down. Another big factor with houses, like we kind of talked about before, is just the supply. So this is realtor.com, just kind of showing the overall supply in a decreasing. Like we're still in such a low supply. The way that this whole supply chain is impacting real estate, more around like construction supplies. So it's definitely impacting builders not being able to get wood. We're seeing wood prices climb. That means new build prices are going to climb as well, and that kind of impacts the whole market in general. So I don't watch the news a lot, but just hearing and chatting with folks, it sounds like supply shock is going to hit us even worse as we get further into 2022. But I, like I said, I don't see that really impacting the housing market a whole lot. So what you guys can do out there, I know I got a lot of investors follow the channel. So how this is impacting investment properties or how you're going out to find them. The bad news is things aren't going to get much better for you in the near term. It's still going to be very difficult to find cash flowing rentals because even if you can find a better deal or there's less folks out there looking for them, the bad news is your interest rate is probably climbed as well for those loans that you're going to get on your rental property. So that also kind of impacts that cash flow. So there's always going to be a way to create deals and find them. My strategy is going off market and finding buyers that way and still trying to make a deal work and just running your numbers. If you're going to now be at a 5.5 or 6% interest rate, that's just how you run your numbers and come up with your offer, right? So I think I've shown folks before, and I got another video where I talk all about how I run my numbers. I use a machine called, or a software called Deal Check. And so, yep, here's the video here where I talk all about, here, I'll take that link here and throw it in the comments. Let's see if I can figure this tech out. All right, so yeah, so if you want to know how I run numbers, yep, I shot that video. I got a promo code in there. I think you get 20% off if you use the link in that video's comments. But yeah, so let's go ahead and I'm gonna stop sharing at the moment and look at. Let me pull up some questions here that I've gotten via DMs and on all different, Instagram comments, etc. So Kyle from Instagram reached out to me the other day talking about HELOCs and said, he said, hey, I was going out to get a HELOC and I told the banker, I was upfront with him and everything and said, hey, I'm going to get this HELOC, go out and look for investment properties. And the bank denied the HELOC because they don't want me to go buy properties with it. And so I think I've gotten several comments about this. So I just want to share my thoughts. This is the very unfortunate thing about HELOCs and telling them what you're going to use them for. I don't ever advocate that you lie or you have malicious intent with these, but I think disclosing too much is also a disadvantage for you because these banks they'll give you a HELOC for almost any other reason but to buy real estate. And now if you think about the logic behind that, I always say you could take a HELOC out, take it to Vegas with you, throw it all on black and lose everything, right? And that's fine. They're okay with you doing that. You can go out and buy a boat that's going to drop in value as soon as you drive it, or as soon as you put it in the water. You can buy a truck, etc. But you want to buy an asset that traditionally goes up in value and they have a problem with it. And the reason behind that is they want to have a lien that they can file against any property that they have debt against. So I get it, but still. So what I told Kyle is, I don't ever disclose that. I always mention, hey, I want this HELOC for to be flexible or to have options if something comes up that interests me. I usually mention, hey, we've always thought about refinishing the basement or remodeling the kitchen. It just so happens I just actually did remodel my kitchen. But yeah, so kind of take that with a grain of salt. Think about that through your own risk profile or your own lens about how you want to express your intent of how you're going to use your HELOC to the bank. But just know if you do tell them you're going out to look for investment properties, you will likely get denied. So keep that in mind. So yeah, and then another question here. This one came from Brad. I think this was maybe a Facebook message. But all right, so Brad said he's like, "Hey, I have a low interest rate now. We say I have a low rate with a ton of equity. How can I use it?" And so typically, I point folks to a video I shot on using a HELOC versus a cash out refinance. Those are typically my two favorite ways to pull equity out of your home and actually go use that. But in this scenario where you have a low fixed interest rate debt on your primary residence, so if you would have gotten a loan, anytime not in the past 4 months, you're probably in like the 2 to 3 range. And so to if you cash out refinance that now, you're going to get a new rate at market rates. So I kind of feel like the way that rates have climbed, it's really taken the cash out refinance off the table. And the HELOC still is a very viable option. And HELOC rates are always variable. So the fact that they went up right now, like I said before, you really just have to factor that into your underwriting when you're going to take on an opportunity. So before, if you're thinking, hey, I'm going to go buy this, Burr deal, I'm going to buy it for 50, rehab it, get all my money back, and you were planning on a 5% interest during that time where you're rehabbing it. Now you're just going to have to underwrite for a little higher and ask yourself if the deal still makes sense. But I do feel like the HELOC is always a viable option in any market, because just opening it up and establishing it, there's really no risk to you at that point. Your risk only comes into play when you actually deploy that money and have to start paying interest on it, because you don't pay any interest until you actually use it. Typically, there's a small fee associated every year with keeping that line of credit open, but it's not in all cases. So I have some that I pay like $100 a year to keep open, a couple others that there's no fee at all, no maintenance fee. So I hope that helps to answer your question, Brad. I would look at a HELOC and get that open, because the prices of houses hasn't declined. It's slowly kind of tapered off, but we are still slowly climbing. So you could still get a very high appraisal on your property. But so I would go ahead and do that, get that HELOC established, so that if you find something, you still can take it down, assuming all your numbers check out. So let me know if that didn't answer your question, or you have follow-ups. Drop those in the comments. If you guys are here, you're getting value out of this, hit a like there. That kind of tells YouTube, like, hey, this guy, someone knows what he's talking about, or maybe they'll point some other folks over here to hang out with us. So again, happy Friday, guys. I hope you got some big plans coming up for Memorial Day. I'm going to answer a couple other questions here. And if you guys have anything, drop them in the comments. We'll answer them live. Although I know it's right after work. Not sure how many folks will get here live with us, but all right. Devin says, I have PMI. Okay, yeah, so I'm also a big advocate of getting rid of PMI on your primary residence. If you got into a property with a low down payment, that's great to get PMI or MIP to get into a home, but I want you to get back out of that as soon as possible. That's what I always advocate for. However, with interest rates rising, and I'm eventually getting Devin to your question, she's asking, so I had PMI, I was planning to get back out of it. However, with to refinance, I'm likely going to, what she said, my rate will jump by almost 2%. Should I still pursue this? So that is a tricky question, because my traditional advice of refinancing to get rid of PMI, because there's no benefit to you. PMI only exists, it gives the mortgage company or whoever gave you that loan, it gives them protection. So you're basically paying for the benefit of the bank to have insurance if something defaults, or they're insuring their money, but you're just paying for it. So that's why I don't like it. However, if your mortgage rate's gonna jump a big percentage just to get rid of that PMI, you're essentially paying more for, again, no benefit, because it's in straight interest. So you're just giving the bank money in general anyway. So I guess you have to pick the lesser of two evils. Would you rather make a PMI payment that goes to insure for the bank, or just you're basically, if you pay them in interest, you're basically just writing them a check? So so the way I would look at this is, get a quote for what your cash out refinance, or not, excuse me, not your cash out refinance, your traditional refinance would be without PMI. Run that mortgage payment versus your current mortgage payment, but then pull up that payment, your mortgage statement, and see what amount of that payment is PMI or MIP, and subtract that. So you're trying to get to compare apples to apples. So if your total payment today is $1,000 and 200 of that is PMI or MIP, let's call it your net payment 800. All right, if you can refinance for, even if your rate increases for less than 800, it may still be worth it to do that. However, it's likely not a considerable amount. So I would probably just tell you to hang tight, depending on how big of a difference that would be in both of those analysis. But yeah, so those are my thoughts on that specific scenario. So I think that is it. Those are the couple questions I wanted to jump on here and just chat with you guys about. I wanted to test out this live functionality for when we want to use it again in the future. hopefully I'll pick a better time that works better for folks to jump on here. Let me know what time, maybe a weekly live video or something like that would help, as the market is ever changing, to try to keep you guys posted on my thoughts and answer any questions you guys might have. But as always, guys, I appreciate you jumping on here, checking the video out. And if you got anything out of it, again, like or subscribe would be greatly appreciated. Share with anybody you know that's kind of interested in this kind of real estate analysis, financials, investments. We kind of talk about all that here. But with that, guys, have a great holiday weekend, and we'll catch you next time. Peace out.